Ruth, I have a confession. The S&P 500 just hit 7,165, a new all-time high, and my first instinct, my gut reaction, was to sell everything, just move it all to cash and wait, because this has to be the top, right? It cannot keep going up forever.
Patrick, do you know how many times the S&P 500 has hit an all-time high since 1957?
I do not know 100. 200?
Over 1,000 times. The market has spent roughly 7% of all trading days at an all-time high. That means if you had avoided investing every time the market was at a record, you would have sat out 7% of all trading days.
Wait 1,000 times?
Over 1,000. And here is the part that will surprise you. According to J.P. Morgan's Guide to the Markets, the one-year cumulative total return after investing at an all-time high is 13% the one-year return when buying on any other day. 12% investing at the scariest moment, the all-time high, has historically performed better than investing on a normal day.
Wait, that cannot be right. You are telling me that buying at the record is actually better than buying on a random Tuesday?
That is exactly what 68 years of data shows, and that is why I call it the ATH Paradox. The safest feeling time to invest, after a dip, is actually worse than the scariest feeling time, at the all-time high. Your emotions have it exactly backwards.
The ATH Paradox. Okay, I need you to explain why, because my brain is screaming that this makes no sense.
It makes perfect sense once you understand how markets actually work. Think about it this way. A market that is hitting new highs is a market where companies are growing, earnings are increasing, and the economy is expanding. An all-time high is not a warning sign. It is a report card. It is the market saying, things are going well.
So the all-time high is not the problem. It is how we feel about the all-time high.
Exactly. And that feeling has a name. Daniel Kahneman, the Nobel Prize-winning psychologist, identified something called loss aversion. We feel the pain of losing money about twice as intensely as the pleasure of gaining it. So when the market is at a record, your brain does not think, great, my investments are growing. Your brain thinks, I have so much to lose right now, and that fear, that completely natural human fear, makes you want to sell at exactly the wrong time.
That is exactly what happened to me. The market hit 7,000, and my first thought was not, my portfolio is doing great. It was, what if it crashes tomorrow and I lose everything I have gained?
And you are not alone. A 2026 investor sentiment report from MarketWise found that 1 in 8 investors admit that fear of missing out drives their decisions. But here is the twist. It is not just fear of missing the upside. It is also fear of missing the exit. People at all-time highs are terrified of being the last one holding the bag.
1 in 8, and those are just the ones who admit it. The real number is probably way higher.
Almost certainly. And this brings us to something I think is really important to understand about the current market. The Nasdaq surged 17.7% in just 13 trading sessions recently. That kind of move feels euphoric, and euphoria is just as dangerous as panic. Because it makes people throw money at things they do not understand.
Okay, so we have the paradox. Buying at all-time highs is statistically fine, but our brains are wired to panic. What about the other side of this? What about the people who say, I will just wait for a dip?
That is my favorite part of this whole topic. Because waiting for a dip sounds so reasonable, it sounds prudent. It sounds like the smart thing to do, but it has a hidden cost that almost nobody talks about.
A hidden cost?
I call it the dip tax. Here is how it works. The S&P 500 goes up roughly 73% of all calendar years. That means in any given year, the market is more likely to be higher 12 months from now than lower. So every month you sit in cash waiting for a pullback, you are betting against the base rate. You are betting on the 27% outcome, instead of the 73% outcome.
Okay, so the odds are literally against you when you wait.
literally against you, and it gets worse. Let me give you a real example. Say you had $100,000 in January 2020, and you decided to wait for a dip instead of investing. Well, the dip came in March 2020. The market dropped about 34% in 33 days. But here is the thing. If you blinked, you missed it. The recovery was so fast that by August 2020, the market was back at all-time highs, and by 2026, that $100,000 invested in January 2020 would have grown by over 114%.
So even if you timed the dip perfectly in March 2020, you only had a 33-day window, and most people who were waiting for a dip were too scared to buy during the actual crash.
That is the cruel irony of the dip tax. The dip you are waiting for is terrifying when it actually arrives. The same fear that made you sell at the top makes you too scared to buy at the bottom. You end up paying twice. You miss the gains on the way up, and you miss the opportunity on the way down.
That is brutal. So what does the data say about lump sum versus dollar cost averaging? Because a lot of people use DCA as a compromise, like, I will not invest it all at once, I will spread it out over a few months.
Great question. Vanguard published a landmark study on this in 2023. They looked at data across the United States, the United Kingdom, and Australia over rolling periods going back nearly a century. And they found that lump sum investing beat dollar cost, averaging 68 to 75% of the time. Not because lump sum is always better, but because the market goes up more often than it goes down. So the sooner your money is in the market, the sooner it starts compounding.
68 to 75%. So roughly 7 out of 10 times, you are better off just investing the money right away.
Roughly 7 out of 10 times, and the average outperformance of lump sum over DCA was about 2.3% over 12 months. That might not sound like a lot, but over decades, that compounds into a significant difference.
Okay, but Ruth, I know someone is going to bring this up. What about Warren Buffett? The greatest investor alive is sitting on $373 billion in cash at Berkshire Hathaway. If Buffett is not investing, why should I?
I am so glad you brought that up, because this is one of the most misunderstood things in investing right now. Yes, Berkshire Hathaway has about $373 billion in cash and short-term treasuries, and a lot of people interpret that as Buffett predicting a crash. But that is not what is happening.
It is not?
No, Buffett has said repeatedly that he would love to deploy that capital. The problem is that Berkshire is so large that it needs to make enormous investments to move the needle. We are talking 10, 20, $50 billion deals, and at current valuations, Buffett cannot find businesses at prices that meet his criteria. He is not timing the market. He is being disciplined about price. There is a huge difference. Buffett is not predicting a crash. He is being patient, and patience is not the same as fear.
So Buffett is not sitting in cash because he thinks the market is going to crash. He is sitting in cash because he cannot find a deal big enough at the right price.
Exactly. And here is the important part for everyday investors. You are not Buffett. You do not need to deploy $50 billion at once. You can invest $500 a month into a broad index fund, and it works beautifully. The constraints that apply to Berkshire Hathaway do not apply to you. Buffett himself has said that if he were investing small amounts, he would just buy an S&P 500 index fund and go about his life.
That is such an important point. People see the headline, Buffett hoarding cash, and they think it means sell everything, but the context is completely different.
Context is everything in investing, and that brings us to the third part of the ATH Paradox, which I call the new normal bias. This is the tendency to treat all-time highs as rare, dangerous events. But they are neither rare nor dangerous.
The new normal bias. Okay, break that down for me.
Think about what an all-time high actually means. It means the collective value of the companies in the index is higher than it has ever been. And why would that be? Because those companies are earning more money, serving more customers, and creating more value than they ever have before. A growing economy should produce all-time highs regularly. A market that never hits new highs is a market in decline. That would be the real danger signal.
So the all-time high is not the ceiling, it is more like a milestone on a road that keeps going.
That is a perfect way to put it, and here is the data to back it up after 3 to 5 years. The forward returns from investing at an all-time high and investing on any other day converge almost completely. The market does not remember that it was at a record. It just keeps reflecting the earnings and growth of the companies inside it.
Okay, but I want to play devil's advocate for a second. What about concentration risk? Because right now, a huge chunk of the S&P 500 is just a handful of tech companies, the Magnificent Seven. Does that change the math?
That is a really thoughtful question, and it is a legitimate concern. The top 7 or 8 companies in the S&P 500 do represent a historically large share of the index, and concentration risk is real. But here is the thing. This is not new in the 1970s. It was the Nifty 50. In the late 90s, it was the dot-com darlings. The market has always had periods of concentration, and it has always eventually broadened out. The solution is not to avoid the market. The solution is to diversify broadly and stay invested.
So the answer is not to time the market. The answer is to own the whole market and let time do the work.
That is the answer. And now I want to give you something practical, because I know we have thrown a lot of data at you, and data is great. But what people really need is a plan. So let me walk you through what I call the ATH Action Plan, 4 steps you can take this week, regardless of where the market is.
Yes, give me the steps.
Step 1. Check your allocation before you worry about whether the market is at an all-time high. Make sure your mix of stocks and bonds matches your actual time horizon if you are 20 years from retirement. A market dip is irrelevant if you are 2 years from retirement. You should already have a more conservative allocation, regardless of where the market is.
So the first step is not about the market at all. It is about you.
Exactly. Step 2. Automate your contributions. Set up automatic monthly investments into a broad index fund. This removes emotion from the equation entirely. You invest the same amount every month, whether the market is at 7,000 or 5,000. You do not think about it. You do not check the headlines. The money goes in automatically.
That is basically dollar cost averaging by default.
It is. And while lump sum beats DCA statistically, automated DCA beats doing nothing because you are scared. The best strategy is the one you actually follow. Step 3. If you have a lump sum sitting in cash right now, and your time horizon is 10 years or more, the data overwhelmingly says, invest it now. Not because the market will go up tomorrow, it might not, but because over 10 years, the probability of positive returns is historically above 90%.
Above 90% over 10 years. That is a powerful number.
It is. And step 4. Delete the app, or at least turn off the notifications. I am serious. The less you check your portfolio, the better your returns will be. Remember the Dalbar data. The behavior gap exists because people react to short-term noise. If you remove the noise, you remove the temptation to react.
Delete the app, Ruth. You are going to make a lot of brokerage companies very unhappy.
Good. Their engagement metrics are not your problem. Your wealth is your problem, and your wealth grows best when you are not watching it.
Okay, let me bring it all together with the takeaways. Number 1, the S&P 500 has hit over 1,000 all-time highs since 1957. Every single time, it felt like the top. It almost never was. That is, the ATH illusion. Number 2, the 1-year forward return after investing at an all-time high is 8.5%, compared to 8.1% on non-ATH days. the scariest time to invest has historically been slightly better than average. Number 3. Waiting for a dip has a hidden cost. I love this one, the dip tax. The market goes up 73% of years, and lump sum beats DCA 68 to 75% of the time. Every day you wait, you are paying a tax nobody sends you a bill for. Number 4. Buffett's $373 billion in cash is about discipline and scale, not a crash prediction. He has said himself that small investors should just buy an index fund. Do not confuse his constraints with yours. And number 5. Use the ATH Action Plan. Check your allocation, automate your contributions, invest lump sums if your time horizon is 10 years or more, and for the love of your portfolio, delete the app.
The market does not know it is at an all-time high, it just keeps compounding, and so should you. Build wealth with patience, not panic.
Follow calm investors wherever you are listening.